Imagine this. Tomorrow morning you wake up and the news is screaming that $500 billion just vanished from the stock market overnight. $500 billion gone, just like that. Your first thought is probably the same as everyone else's. Where did all that money go? Who has it now? Did it get transferred to some secret vault somewhere? Did the rich get richer while everyone else got poorer? Here's the thing that's going to blow your mind. The answer is nowhere. That money didn't go anywhere because it was never really there in the first place. And by the end of this video, you're going to understand exactly why, using a simple example that will change how you think about money forever. Let me tell you about Sarah. Sarah owns 100 shares of TechCorp, a company she bought at $50 per share. She paid $5,000 of her hard-earned money for these shares. Last month, TechCorp was trading at $80 per share. On paper, Sarah's investment was worth $8,000. She felt pretty good about her $3,000 gain, even though she hadn't sold a single share. Then last week happened. Some bad news hit the market. Investors got nervous. TechCorp's stock price dropped to $60 per share. Suddenly, Sarah's portfolio showed $6,000 instead of $8,000. According to her brokerage account, she just lost $2,000. But here's the million-dollar question. Where did that $2,000 go? The shocking truth is that it didn't go anywhere. It never existed as real money in the first place. I know this sounds crazy, but stick with me because I'm about to show you exactly how this works using an example so simple that a 10-year-old could understand it. Imagine you're at a massive farmer's market. This isn't just any farmer's market, though. This is the world's biggest farmer's market, where instead of stocks and bonds, they're selling apples. Millions and millions of apples. Now, let's say there are exactly 1 million apples available for sale today, and every single one of them has a price tag of $5. What's the total value of all the apples in this market? Simple math tells us it's $5 million. 1 million apples times $5 each equals $5 million total market value. But here's where it gets interesting. Most of these apples aren't actually being sold. They're just sitting there with price tags, waiting for buyers. Maybe only a few thousand apples actually change hands on any given day. The vast majority of the million apples are just sitting there with their $5 price tags, contributing to that $5 million total market value. Now imagine something happens. Maybe there's news that apple production is going to increase dramatically next season, or maybe a health study comes out questioning whether apples are as healthy as we thought. Whatever the reason, buyers suddenly become less willing to pay $5 per apple. The market sentiment shifts. Sellers start lowering their prices to attract buyers. Within hours, the price tags on apples throughout the market drop from $5 to $4. What just happened to the total market value? It dropped from $5 million to $4 million. $1 million just disappeared from the apple market. But where did that $1 million go? Did someone pocket it? Did it get transferred to some bank account? Did the apple sellers lose actual cash from their wallets? The answer is no. That $1 million never existed as real money. It was just a mathematical calculation based on the price that people were theoretically willing to pay for apples. When the price dropped from $5 to $4, the only thing that changed was people's perception of what an apple was worth. No actual money changed hands for most of those apples. The $1 million loss was just a recalculation of hope and expectation. This is exactly what happens in the stock market, but instead of apples, we're talking about shares of companies. Let's go back to Sarah and her TechCorp shares. When TechCorp was trading at $80 per share, the stock market was essentially saying that if someone wanted to buy TechCorp shares right then and there, they'd have to pay $80 each. This price was based on the most recent transactions and what buyers and sellers were willing to agree on. But here's the key point that most people miss. That $80 price was just the most recent agreement between one buyer and one seller. Maybe only a few hundred shares of TechCorp actually traded at $80 that day. The other millions of shares outstanding were never actually sold at that price. They were just assumed to be worth $80 based on that small sample of actual transactions. When TechCorp's price dropped to $60, it meant that the most recent buyers and sellers agreed on a lower price. Maybe this was because of bad earnings news, or industry concerns, or just general market pessimism. The point is that the new price of $60 became the benchmark for valuing all TechCorp shares, even though the vast majority of shares never actually traded hands at either $80 or $60. So when Sarah's portfolio value dropped from $8,000 to $6,000, where did that $2,000 go? It went nowhere, because it was never real money to begin with. It was just a paper calculation based on what someone might theoretically pay for her shares if she decided to sell them at that moment. Think about it this way. If Sarah never planned to sell her TechCorp shares anyway, did she really lose anything? She still owns the exact same 100 shares of the exact same company. The company didn't suddenly become worthless overnight. Its factories are still running. Its employees are still working. Its products are still being sold. The only thing that changed was other people's perception of what those shares might be worth if they were sold today. This is why Warren Buffett famously said that the stock market is a voting machine in the short run, but a weighing machine in the long run. Day to day, stock prices are driven by emotion, sentiment, and speculation. People vote with their wallets based on how they feel about the future. But over the long run, stock prices tend to reflect the actual value created by the underlying companies. Let's make this even more concrete with some real numbers. Imagine the entire US stock market has a total value of $30 trillion on Monday. This number comes from adding up the current share price of every publicly traded company multiplied by the number of shares outstanding. It's a massive calculation, but it's just math based on the most recent trading prices. Now imagine that on Tuesday, some concerning economic news comes out. Investors get nervous and start selling. By the end of the day, the total value of the US stock market has dropped to $27 trillion. $3 trillion of market value just evaporated in a single day. The headlines scream about the massive losses. Politicians give speeches about the economic crisis. People panic about their retirement accounts. But here's what actually happened. Maybe only 1% of all outstanding shares actually traded that day. That's still hundreds of billions of dollars worth of transactions, which sounds like a lot, but it represents a tiny fraction of all the shares that exist. The other 99% of shares never changed hands. They were just revalued based on the prices that the 1% of actively traded shares achieved. So when $3 trillion of market value disappeared, it's not like $3 trillion in cash was destroyed or transferred somewhere else. It's more like the market collectively decided that shares, which were previously valued at $100 each, were now only worth $90 each. The $10 difference multiplied across billions of shares adds up to trillions of dollars, but most of those shares never actually traded at either price. This is fundamentally different from other types of losses that you might experience in life. If your house burns down, you've lost something real and tangible. If someone steals money from your bank account, that money is actually moved from your account to somewhere else. But when stock values fall, no real assets have been destroyed and no money is actually moved. It's purely a change in perception and expectation. This doesn't mean that stock market losses aren't real or don't matter. They absolutely do matter, especially for people who need to sell their shares. If Sarah needed to sell her TechCorp shares to pay for her daughter's college tuition, then the drop from $80 to $60 per share would represent a very real $2,000 shortfall in her available cash. But for investors who don't need to sell immediately, paper losses are exactly that, just numbers on paper. The shares still represent ownership in real companies that continue to operate and hopefully grow over time. If TechCorp continues to innovate and increase its profits, the share price will likely recover and potentially reach new highs. This is why financial advisors always tell people not to panic during market downturns. If you don't need the money immediately, you can simply wait for the market to recover. History shows that while stock markets can be volatile in the short term, they tend to trend upward over long periods as the overall economy grows and companies become more profitable. The same principle works in reverse during market booms. Like when stock prices are rising rapidly and everyone's portfolio values are increasing, that newfound wealth isn't entirely real either. It's based on the theoretical price that shares could be sold for, but only if there are enough buyers willing to pay those high prices. During speculative bubbles, prices can rise far above what companies are actually worth, creating paper wealth that disappears just as quickly when reality sets in. Think about the dot-com bubble of the late 1990s. Internet companies with no profits and questionable business models were valued at billions of dollars. People felt wealthy on paper, but when the bubble burst, trillions of dollars in market value evaporated. That money didn't go into someone else's pocket. It simply never existed as real money in the first place. The same thing happened during the housing crisis of 2008. Home values had been inflated by speculation and easy credit. When the bubble burst, homeowners saw their property values plummet. Where did all that lost equity go? Nowhere. It was just a correction back to more realistic valuations. Understanding this concept is crucial for making smart financial decisions. When the media reports that billions or trillions of dollars have been wiped out in a market crash, they're not reporting on the destruction of actual money. They're reporting on a change in the collective opinion about what various assets are worth. This is also why you shouldn't make investment decisions based on daily market movements. The day-to-day fluctuations in stock prices are largely noise driven by emotion, speculation, and short-term thinking. The actual value of the companies you own doesn't change nearly as dramatically as their stock prices suggest. Let's consider another angle. When stock prices fall dramatically, some people do benefit. Smart investors with cash on hand can buy shares at discounted prices. Companies can buy back their own stock cheaply, which benefits long-term shareholders. Employees might get stock options at lower prices. But the money for these purchases doesn't come from the theoretical losses experienced by existing shareholders. It comes from separate pools of capital that were waiting for better buying opportunities. There's also an important psychological element to understand. Market crashes feel devastating because humans are naturally loss-averse. We feel the pain of losses much more acutely than we feel the pleasure of equivalent gains. When you see your portfolio drop by $20,000, it feels like you've lost $20,000 of real money, even though you never actually had that money in cash. This emotional response is natural and understandable, but it can lead to poor decision making. Many investors sell their shares at the worst possible time because they can't stand watching their paper losses grow larger. By selling, they convert their paper losses into actual cash losses. They turn theoretical decreases in value into real reductions in their bank account balance. The investors who do best over the long term are usually the ones who can ignore short-term market volatility and focus on the underlying fundamentals of their investments. They understand that stock ownership represents a claim on real businesses with real assets, employees, and customers. As long as these businesses continue to create value, their stock prices will eventually reflect that value, regardless of temporary market sentiment. So the next time you see a headline about billions of dollars being wiped out in a market crash, remember our Apple market example. The money didn't go anywhere because it was never really there as cash in the first place. It was just a calculation based on the price that a small number of buyers and sellers agreed upon for a tiny fraction of the total shares available. Stock markets are fundamentally mechanisms for discovering prices and allocating capital. They're not giant cash registers that move money from one person to another every time prices change. They're more like massive opinion polls that constantly survey investors about what they think various companies are worth. When opinions change rapidly, as they do during market crashes, prices can move dramatically, even though the underlying companies haven't changed much at all. This creates opportunities for patient investors who can see beyond the short-term noise and focus on long-term value creation. The key takeaway is that stock market values represent hope, expectation, and collective opinion much more than they represent actual money. When a stock market crash wipes out trillions of dollars in value, it's really just a massive repricing of those hopes and expectations. No money has been destroyed or transferred. The market has simply admitted that its previous optimism was excessive and that more realistic valuations are warranted. This understanding can help you make better investment decisions and avoid the panic that causes so many people to buy high and sell low. Remember that behind every stock price is a real company with real assets and real potential for creating value over time. As long as you're investing in quality companies and don't need the money immediately, temporary market downturns are just opportunities to buy more shares at discounted prices. The money does not go anywhere when markets crash because it was never there as real money in the first place. It was just hope and expectation. And when those change, so do prices. But hope and expectation can change again, often quite quickly, which is why patient investors who understand this principle tend to do so well over the long term. This is just one piece of the bigger picture. Subscribe if you want to understand the full context and how to better protect yourself in uncertain times. And the video on screen takes this story one step further.